Hello everybody, welcome back to Valuation Investing, and in this video I'm going to be valuing 15 stocks and ranking them on a scale of whether or not I would be buying these stocks at these prices. So with that being said, let's take a look at the ranking system I'm going to be using. As we can see with this ranking system, I have it from must buy all the way to sell now. So with the first rank, I'm going to have must buy, which is going to be greater than 15% return that I expect when we use an intrinsic value calculator. Then I have undervalued, which I would expect us to make about 12 to 15% each year in these stocks. Then fair valued is anywhere from 8 to 12% since the stock market has returned about 10% in the past. Then I have overvalued anywhere from 5 to 8% expected annual return on these stocks. Then for the final rank is sell now, and I'd expect in the future to only return less than 5% year over year on one of these stocks. So with that being said, let's get into the rankings. As we can see here with the first stock, we have Microsoft. And Microsoft, if we take a look at the stock over the past 5 years, it's been up 152%, and it has just recently reached an all-time high and is almost at $500 per share. But if we take a look at the revenue growth of Microsoft, we see very good revenue growth at a very good rate, anywhere from 10 to 20% revenue growth each year. This is very good growth, going from $59 billion to 2010 all the way to $270 billion in revenue. But if we take a look at Microsoft's earnings per share and PE ratio, which is right here, we can see that earnings per share looks very similar to the revenue growth, growing at a pretty good rate. However, I would like to add, look at the PE ratio of Microsoft. Trading at about an 8 to 10 PE ratio during 2010, which is insanely undervalued, which the stock market trades at about 20 to 25, we can see that Microsoft's valuation has gone up to 38, which is almost 4 times the amount of valuation that Microsoft is trading at. So compared to 2010, it looks insanely overvalued. But if we take a look at analyst expectations for their earnings per share growth rate, we can see that they're expected to grow at about 14.8% in the next 5 years. So each year, their earnings is expected to grow at a pretty fast rate. And we would like this to be greater than 5%, showing that in the future they're expected to grow at a good rate, and since it's almost 15%, this is very good for Microsoft. If we go to our intrinsic value calculator for Microsoft, we're going to start off with the revenue growth rate assumptions. So since analysts expected their earnings to grow at anywhere from 14 to 15%, I'd like to be a little conservative there, and since that's the earnings and this is revenue, normally the revenue grows at a slower rate, and if we see over the past 10 years, Microsoft's been growing at about 11%, and over the past few years, it's actually been a little faster at 13%. So I think a 12% revenue growth rate for Microsoft is reasonable. Now for the net profit margin, I'm going to put this at 35%. Since it's been hovering around that 34 to 36% mark, I think 35% for Microsoft is reasonable. Now for the terminal PE ratio, they've been trading at a very high valuation over the past, say, 5 to 10 years. I do not think that they deserve that much of a premium, but I do think that they're a higher quality company, so I'm going to put a 27 PE ratio. Finally, for the discount rate, I'm going to put 10% since that's where we'd like to see our intrinsic value. So for this, I have a fair value price for Microsoft at $549 per share, which shows us if you bought this stock today, you'd probably make about 11% year over year on this stock. So with that being said, I'm going to put Microsoft in the fair value category because we're going to be expecting about 11% annual return on Microsoft, and that's about the market average over the past few years. So I do expect you to return a pretty good rate on Microsoft, and this is a very good company to purchase, but I do not see huge returns on this company. So now for the next stock, we have Nvidia, and as we can see over the past 5 years, we've seen incredible gains from this company, up 1,600% as a result of the huge AI boom and all these companies needing these chips for AI. And if we go ahead and take a look at Nvidia's revenue, we can see just insane revenue growth, going from $3.5 billion in 2010 all the way to $148 billion. We can see their growth rate over the past few years is almost in triple digits, which is just insane by Nvidia. But do I think this this is going to last. I highly doubt that they're going to be growing at this fast of a rate. I do think this will definitely slow down. And as we saw, it definitely is starting to slow down. And the earnings per share right here in the middle, we can see once again growing at a pretty good rate with the stock price, which we always probably will see that. And PE ratio, the PE ratio actually isn't terrible for Nvidia when compared to the past. They haven't been at this low of a valuation since basically 2020. So even though Nvidia is at all-time highs, their valuation with their PE ratio is actually pretty low. So that's not too bad for Nvidia, especially with the fast growth rate. And now for analyst expectations, they're expected to grow at about a 28% rate over the next 5 years in their earnings per share. So that looks pretty good for Nvidia right there. Now for the intrinsic value calculator for Nvidia. I'm thinking a revenue growth rate of anywhere to 15 to 20%. I'm thinking a 17% revenue growth rate is pretty fair. Even though they expected their earnings per share to grow at 28%, I do think that it's going to slow down a lot, and especially the revenue growth rate isn't going to keep up. Now with the net profit margin, I do think that as we can see over the past year, it's been at about 52%, but I don't think it's going to sustain that high of a profit margin. So I'm going to be a little conservative and go at 45%. And now for the PE ratio, I'm actually going to leave this at 27 for Nvidia. And with the discount rate of 10%, I have a fair value price for Nvidia at $174 per share. And if you bought this today, you'd make almost the exact same return as Microsoft of about 11%. So once again, we have another company going into the fair valued category, which is Nvidia. Now for the next company, we have Apple, which is one of the biggest moat companies and actually Berkshire Hathaway's biggest holding. And if we take a look at Apple's stock performance over the past 5 years, we can see it's been the worst performer when compared to the first two companies of Nvidia and Microsoft, which has a return of 127%, which is still a very good return, greater than 20% each year. So this has still been a very good return with Apple. But if we take a look at Apple's revenue, we can see when we compare it to these other two companies that we just analyzed, it looks a little bit worse with slower growth rates, and it's been stagnant over the past 3 years, been remaining at basically the same revenue. So this doesn't look very good for Apple, but it does look like they are starting to increase that revenue just a little bit in the past year. So while Apple is looking not as great as these other companies, they do have a bigger moat, I believe, than these other companies. So that's one thing to consider with Apple. But if we also take a look at Apple's earnings per share growth rate, we can see it's been pretty good until 2022, and it's been flat since 2022 basically. So the earnings per share that us investors are getting has been the same. But look at the PE ratio. The valuation of Apple has been going up a lot, even though the earnings per share hasn't been changing. So that's one thing to keep an eye on. And Apple's actually at one of its most overvalued prices basically ever. So that's one thing to consider about this company, and I don't really like. But if we take a look at the analyst expectations for the next 5 years of their earnings per share, they're expected to grow about 12.5%. If we factor this into our intrinsic value calculator, I do not think that they're going to grow that fast with their revenue growth rate. While I do believe their earnings per share will grow that fast, they are buying back shares at about 5%. Basically, we can subtract that from the earnings per share that analysts expect and basically have about a revenue growth rate of 7 or so percent. So I'm thinking a revenue growth rate of 7 or 8% is fair for Apple. I'll be a little bit optimistic for Apple at 8%. Net profit margin, we can see it's been very consistent at about 25%. Let's put that right at 25%. Now for the terminal PE ratio. While Apple is a huge moat company, their revenue growth rate is pretty slow. So I do think that they should fall between the 20 and 25 PE ratio, since that's where the market is on average. And although Apple isn't an average company, their growth rate has been slowing pretty fast. And also, it's just not as good of a company anymore. But they still have a huge competitive advantage and moat. So that's a good thing for Apple. But I'm actually going to put a PE ratio of 23 for Apple. And as we can see here, we get a fair value price of Apple at $187 per share with a forecasted return of 9%. So once again, we have this Apple going into the fair value category. If we go ahead and take a look at our ranking, we can see it's going right there. Compared to Microsoft and Nvidia, Apple does look a little bit worse than these other two companies. The next company that I'm going to be looking at is Google, or what is known as Alphabet. And if we take a look at the Google stock over the past 5 years, it's returned about 162%. But what's interesting is year to date, it's actually down almost 7%. So far, Google this year is not performing as well as the stock market because of worries over AI taking over Google search, and also the lawsuits that is against Google and potentially the DOJ breaking up Google Chrome, which is probably why the stock has not been returning a lot. But if we take a look at Alphabet's revenue, we can see once again just very good growth from these companies, which is why they are the biggest companies, because they're so good. And look at this growth, just increasing at a great rate. Look at that, still almost double digits from Google revenue. So that's very good. And then if we take a look at the earnings per share, once again, just increasing very consistently besides 2022, where it decreased a bit. And if we take a look at the PE ratio, it's trading at a 19 PE ratio, which the stock market right now is at about a 25 PE ratio. And we saw Apple with a PE ratio of almost 40 and Microsoft almost 40 and Nvidia at 50. So far with the PE ratio, Google looks a lot more undervalued compared to those other companies, which is probably just because of the concern over the company and AI taking over the business. So that's the slight worry for Google. But if we take a look at analyst expectations, they're expecting them to grow at almost 15%, which is faster than Microsoft and Apple. So far Google is looking very undervalued, but yet their growth rate is looking pretty good. So this looks pretty good so far for Google. Now with Google's estimates, they expected to grow at about over 14%. So I'm thinking for the revenue growth rate, 10% is pretty reasonable. Especially I'm going to keep it a little conservative because of the slight worry about AI and the DOJ breaking them up. I do think that's fair. Now for the net profit margin, which has been around 24 to 30%. So I'm actually going to put this at 27. Even though in the past year it was at 31%, I'm pretty sure in the recent earnings there's a slight fluke in that net profit margin which increased it at a crazy value. So I personally do not believe that that is fair. Now for the terminal PE ratio, I'm going to put this right at 23 just because I do think Google still has a big moat with Google search. And they also have a lot of other things like Waymo, which is basically the only self-driving robo-taxi and is way ahead of Tesla. And they also have so much other things like YouTube right now. So I think this is fair, and with a discount rate of 10%, I have Google returning about 15%. And with a fair value price of $260, I do think Google is a must-buy today. So this is the first stock going into the must-buy category, barely scraping in at exactly 15% annual return expected. Now for the next stock, we have Amazon, which is known for their shipping. However, they actually don't make any money on that business. They actually make most of their money from AWS, which is their software that they offer to other companies. So if we take a look at Amazon stock, we can see over the past 5 years, it's only gained 65%. So not a good gainer, the worst one we've seen so far. But that is from such a high valuation from COVID that people were buying so many things off Amazon, which is probably why the stock was up so high there, and it's only returned 65%. But if we take a look at Amazon's revenue, similar to all these other companies, they've been growing pretty good. However, since 2022, they've been growing at a high single digit to low double digit number. So it is slowing down a lot, but it makes sense when you're at $650 billion in revenue. You can't just keep going on forever at such a fast rate. So it makes sense. But now if we take a look at the Amazon PE ratio and earnings per share, once again, earnings per share over time growing at a good rate. And the PE ratio is actually at its lowest, I think, ever. Yeah, the PE ratio is actually at its lowest Amazon has ever had it. No, it actually is the lowest ever in the past 15 years. So far the valuation looks pretty good, but that doesn't mean we should just go buy Amazon. But for the next 5 years, Amazon is expected to grow at about a 21% rate by analysts. So that is insanely fast. The second fastest of these stocks that I've valued so far. Now if we do the Amazon value calculator, I'm going to use a revenue growth rate. While this might be controversial, I think that they're going to grow at 10%. I don't think that the earnings per share growth rate should be used for our revenue growth rate, just because The earnings per share is probably going to go up because of their net profit margin increasing over time. As we see right here, it's gone from 1% to 9% pretty consistently. So each year it's been growing about 1% for Amazon in their net profit margin. And I think that's what analysts expect them to do, but the revenue growth rate to slow down a little bit. So that's what I think is going to happen. Now for the net profit margin, I think that they can get anywhere from 15 to 20%. But I'm going to put a 17% net profit margin just because I do think that they can grow this very high, especially with AWS and other business ventures. I think that they can get this up there. Now for the next thing that I'm going to look at is the terminal PE ratio. For the terminal PE ratio, I'm actually going to put 25. The reason I'm going to put 25 is just because they're such a big moat and they're just going to be increasing that net profit margin more and more over time. And with this, I get a fair value price for Amazon at $358 per share. And with this, I have a forecasted return of 16.3% year over year. So with that being said, Amazon is going into the must buy. However, if we play around with the numbers for the net profit margin, say they only grow to 12%. I think that you could only return about 11.6% or 15%, which is pretty reasonable too, about 14.6%. But nonetheless, I think 17% is achievable in the next 10 years. Since we're at about a 10% net profit margin today, I think that they can actually get up there in time. So with that being said, I think Amazon is a must buy today. Now we're going to take a look at Meta. Meta has had a pretty good performance in the past 3 or so years, but if we take a look at the past 5 years, it's still very good at 240% almost, which is just insane growth. But if you bought this dip in 2022, you're up over 700%. So we can see that Meta has rallied so much in the past few years. But if we also take a look at the revenue, we can see that it's basically the same thing with the stock price. We saw a little dip in 2022, and once again, we're right back to double-digit revenue growth rate of almost 20%. So very good from Meta right there on the revenue growth rate. And also earnings per share, once again, growing insanely fast. And the PE ratio is pretty cheap. Although it's not as cheap as 2022, it's still pretty darn cheap compared to the other years at about a 28 PE ratio. So it's not very undervalued when compared to the other PE ratios that it's had, but it's still in a pretty good spot. Now for the next 5 years, analysts expect them to grow about 16% earnings per share. So that's also pretty good from analysts. And now if we do the intrinsic value calculator, I'm going to use a revenue growth rate of 13%. Since analysts expect them to grow about 16%, I'm going to be slightly conservative here, say 13%. Now for the net profit margin, we can see that in the past year they're at almost 40%, but they've averaged about 30%. So I'm thinking a 35 net profit margin is pretty fair for Meta. Now for the terminal PE ratio, I'm going to leave the terminal PE ratio right at 25 also for Meta. I think that's pretty fair. And with this, I get intrinsic value for Meta at $1,020. So with this, I get an annual return of 14.2% each year. And with that being said, Meta, I think, goes into the undervalued category. I don't think it's a must buy today, but it is undervalued, I personally believe, to the stock market. So right now we have 2 in the must buy, 1 in undervalued, and 3 in fair valued. Now for the final stock of part 1 of this video, this is going to be Visa. And if we take a look at Visa's stock, it's been pretty underperforming over the past 5 years compared to these other companies, growing at about 84%. While this still is very good returns, it's still not as much as most of these other companies are already valued. Now if we take a look at Visa's revenue, we can see very good revenue growth rate in pretty consistent at about 10 to 15%, I would say, for Visa. So this very consistent growth. And if we take a look at the PE ratio, it's been trading pretty much around its average since 2015, anywhere from the high 20s to mid 30 PE ratio. So right now it is pretty high PE ratio at 37 right now. But if we take a look at the earnings per share, just increasing so fast. And then at the Visa, if we take a look at their analyst expectations over the next 5 years, they're expected to grow at about a 13% rate. So pretty slow compared to most of these other companies, but it's still very good growth. If you just see over greater than 5% growth, that's still pretty good for a company. And over 10% is just very good. So it's still pretty good, although not as good as some of these other companies. It's still looking good for Visa. And the one thing I like about Visa is the high profit margins, and it's just been very consistent at that level. But for the revenue growth rate, I'm going to put a revenue growth rate of 12% for Visa. I think that they can stay at around 10 to 12% for Visa, and I'm a little bit more bullish on Visa. Now for the net profit margin, I'm going to put this right at 50. Actually, I'm going to put this, yeah, 53% for Visa. I think that's a fair price. Now for the terminal PE ratio. They've been trading pretty high at this 30 to 34 range, and I do think that they deserve a pretty good premium just because of their huge profit margins. I'm going to put this at 27 like other companies like Microsoft. So right now we can see that with Visa I get a fair value price of $392 per share and a forecasted return of 11.5%, which means that we're going to throw this into the fair valued category in front of Microsoft. So thank you guys for watching this video. I'm going to be making part 2 tomorrow, so subscribe to the channel, turn on post notifications to see these other companies I'm going to be valuing, which is Broadcom, Oracle, United Health, Tesla, Adobe, Nike, Palantir, and Uber. But these were the first 7 stocks that I valued. Then we have 8 more to go. So we valued Google and Amazon, which I believe are must buys, which we also have Meta at undervalued. Then we have Visa, Microsoft, Nvidia, and Apple at fair valued. So with that being said, thank you guys for watching this video. Stay tuned for the next episode, and see ya.